Okay, so I'm going to do a review for the midterm next week, midterm 2. This exam is going to be on April 23rd. So let me write that down. April 23rd. You will have the full class period for this exam. So the exam will be during the regularly scheduled class hours, and I might put like extra 5 or 10 minutes for you to work on this exam. So it will start at the regular class start time, and you will have about an hour and 20 minutes to work on this exam. Uh, 5 chapters are covered on this exam: chapters 7, 8, 9, 15, and 16. Chapter 7 on CAPM and asset pricing. Chapter 8 on market efficiency. Chapter 9 is behavioral finance. Chapter 15 is options, and chapter 16 is option valuation. Okay. Just like the quiz, the midterm is going to be on titanium. It will be all multiple choice. So you will have somewhere between 30 to 35 multiple choice questions. All right. The so in, this is this is going to go fast. I mean, you will have about 80 minutes to work on about 35 questions, I would say. So little over 2 minutes for each question. That would include some conceptual questions for which you don't have to do any calculations, but that would also include some calculation questions. You will really have to manage your time well, and what that would also mean is that you need to be thoroughly prepared for all this material that we have covered in these 5 chapters, because you will not have a whole lot of time to look through your page of notes and stuff like that to try to find the relevant material to answer a particular question. All right, so make sure you are well prepared to take this exam and answer all questions. Again, about 35 multiple choice questions. I anticipate each question to be worth about 3 points each. So again, just like the first exam, this should be about 105 points or so. All right, but I might make some minor changes here and there if I decide to do that. I'll let you know. But at this time, I'm planning to keep the same format as our format for the quiz. Okay, so what I want to do is I want to just go over all the highlights of these different chapters that we have covered, just to recap some of the material, refresh your memories, and then what you can do, since the exam is still a week away, you can log in to the Zoom sessions. I will make myself available during office hours, of course, but I'm also usually available during regular class hours on Zoom, except for occasional breaks. I'm usually there. Some of you have spoken with me in Zoom sessions, so feel free to ask any questions that you might have for the upcoming exam. Okay. This is the review document that I have prepared. I'm going to post this on Titanium, or actually I'm going to mail this to you. So I'm going to send out an email with all the information about the exam, and I'll attach this review document with highlights from each of the chapters along with that email, so that you have this information. Okay, but I will go over each of these chapters one by one. So chapter 7, CAPM and asset pricing, we started with the assumptions, right? So a number of different assumptions are built into CAPM, and then, as you know, CAPM basically builds upon the idea that this tangency portfolio is the market portfolio. It is the optimal risky portfolio for investors, and based on that, when we do the analysis, also utilizing the fact that uh, the market portfolio has a beta of 1, you can then arrive at this CAPM equation, right? So this is the CAPM model. We also did a plot of CAPM, right? So security market line, that's the plot of CAPM. That's the beta on the x-axis and expected return on the y-axis, right? And then we introduced this concept of alpha, that is the abnormal return, right? So alpha is basically your forecast minus the CAPM expected return. So we talked about the significance of alpha, how positive alpha signifies underpricing, negative alpha signifies overpricing. Then we learned how to compute the beta of the portfolio. That's a straightforward calculation. Weight times the beta of securities added up across all the securities in the portfolio. That gives you the portfolio beta. All right. We talked about the index model. So index model is the transformed version of CAPM. We use some proxies like S&P 500 for the market, T-bills for the risk-free rate, and so on. So because we are making all these approximations, we don't get a perfect model. We get a transformed version of CAPM, and that is the one that we can actually use in real-world applications. Okay. And then we have multi-factor models. So we talked about some limitations of CAPM and how that led to multi-factor models. And we spent some time talking about the Farmer-French three-factor model, right? So Farmer-French three-factor model, CAPM is a single-factor model. The only risk factor is the market beta in CAPM. Farmer and French introduced two additional factors based on empirical analysis. So one is the size factor, SMB, that stands for small minus big. That is based on the evidence that small firms have done better than large firms historically, a finding that cannot be explained by CAPM, right? So that is the size beta, SMB beta, and the other factor that they included in the model is the HML, right? So HML stands for high minus low, high book to market ratio minus low book to market ratio. High book to market firms are value firms, low book to market firms are growth firms. Empirical evidence suggests that value firms have outperformed growth firms historically, and again, CAPM cannot explain that result, and therefore that is included as an additional risk factor in the model. So we have this three-factor model by Farmer and French, a very popular, widely used model. We also talked about arbitrage pricing, which is based on this very basic notion of arbitrage in finance. And this discussion was mostly intuitive. Basically, the result was that for a well-diversified portfolio, all the points here on this graph should line up. Any deviation from a straight line results in an arbitrage opportunity, and that can be used to come up with a relationship between risk and return, right? So if you assume that market risk is the only systematic risk factor, then you get the same relationship as CAPM here for well-diversified portfolios. So we did a comparison between APT and CAPM, and basically the key here is that APT is more general than CAPM. It does not require as many assumptions, and it can actually incorporate multi-factor models as well. Okay, so that is what we learned in chapter 7. Okay, chapter 8, if you look at the reading assignment from this chapter, I'm asking you to read the entire chapter here. There's not a whole lot that we have actually skipped in this chapter. So this is all descriptive, no numerical questions from chapter 8. We talked about the random walk and how that is related to market efficiency idea, the role of information in market efficiency. So if all the information is fully reflected in prices, we say that the markets are efficient. To set the stage for what kind of evidence people look for, we introduced a couple of examples. And then competition, we said that the source of market efficiency is competition. We talked about different versions of market efficiency. So if only past information is reflected in prices, we say that it's weak form efficiency. If all publicly available information, including past information, is also reflected in prices, we say that markets are semi-strong form efficient. And then strongest version of efficiency includes all information public as well as private. All right, so there's like a ever increasing set of information as we go from weak form efficiency to strong form efficiency. We talked about some implications of market efficiency, technical analysis that is based on historical information, fundamental analysis that is based on publicly available information. So we said that if technical analysis is successful, that suggests that markets are not weak form efficient because you can use historical or past information to your advantage. Similarly, if fundamental analysis is successful, that is inconsistent with semi-strong form efficiency, since you are able to use publicly available information to come up with profitable trading strategies. And then active versus passive. If you are an active investor, you do not believe that markets are efficient. If you are a passive investor, you believe that markets are efficient, right? So active and passive investment. Uh, then we'll talk about some of the issues that we need to be aware of in interpreting the evidence for or against market efficiency. So we talked about the magnitude issue, we talked about the selection bias, and we talked about luck versus skill. Okay, and then most of the remaining time in this discussion we spent on looking at different return patterns in the historical data. So we talked about momentum and reversals, we talked about the PE effect, uh, the size and book to market effect, the post earnings announcement drift. There was one more that I introduced that is known as the asset growth effect. So it should be in your notes, it's not on the slides or in your textbook. So we talked about these different return patterns in the historical data that seem to suggest that perhaps markets are not efficient, right? So I have listed all those different patterns that we have talked about in class and that you should be familiar with. Then how do we interpret these results? How do we interpret these patterns? It could be due to risk or it could be due to inefficiency, right? So that debate would never be resolved. There's also this issue of data mining, that when you repeatedly analyze the same data, just by chance you would come up with some return patterns, right? So that is another issue in interpreting this evidence. And then lastly, we looked at the performance of financial analysts and fund managers, right? So for analysts, we looked at their recommendations, and the evidence was that the evidence here was not very convincing that that you can actually rely on the recommendations. Similarly, for mutual funds, the performance wasn't as expected. Actively managed funds are not generally able to outperform their benchmark. So both of these pieces of evidence seem to suggest that markets are largely efficient. So we saw a lot of evidence. It seemed to suggest that markets are inefficient, but also evidence which is consistent with market efficiency. And in the end, you need to form your own belief regarding market efficiency, right? Whether the markets are efficient or not. So that was the conclusion. Chapter 9, we started with some anecdotal evidence of irrational behavior, right? So we looked at some evidence here that suggests that investors are not always acting in a rational manner. And then we sort of systematically looked at different behavioral biases, right? So we looked at forecasting errors, overconfidence, conservatism, representativeness, anchoring, and adjustment bias. And in many cases, we also looked at the applications of these biases to understand some of those return patterns, right? So make sure you have a basic understanding of this various biases that we discussed in class, okay, and their applications. And then we talked about framing, how the choices are framed can result in different decisions. Like we looked at this example of same information presented different ways in the survival frame and mortality frame, and that led to very different outcomes in terms of decision making. So one specific type of framing that has found a lot of application in finance is known as mental accounting, like this house money effect, and all those are examples of mental accounting, which is the idea that people segregate decisions into different mental accounts, right? And then we talked about this very important development in the field of finance, which is known as prospect theory. This prospect theory changed people's view on how people derive utility from wealth, right? That's the conventional view is that people are risk averse, and therefore you have this concave utility function when you plot utility against wealth. The prospect theory view is that people care more about change in wealth rather than absolute level of wealth. So people care more about profits and losses. When they are facing the prospect of a gain, the utility function is concave. They are risk averse. But when they face this prospect of a loss, the utility function is convex, and that is consistent with risk seeking or risk loving behavior, right? So it's just overall we get this S shaped prospect theory utility function. Okay, and mental accounting and prospect theory together have been used to explain this very pervasive behavioral bias that is known as the disposition effect. So that is another bias that we can add to our list of biases: the tendency to sell the winning stocks too quickly and hold on to the losing stocks for too long. Right, so this first part of behavioral finance talking about various biases, and then the second part of behavioral finance is related to this limits to arbitrage argument. So this is the answer to the critique as to why rational investors do not take advantage of mispricing, right? Why do these return patterns persist? They do not go away. And this is the answer from the behavioral field to this critique. And these rationales are basically categorized under the limits to arbitrage argument, right? What is limiting the arbitrage? So we talked about different factors like fundamental risk, noise trader risk, implementation cost, model risk, and so on, right? These are the various factors that might deter rational investors from fully exploiting any mispricing. And then we have two chapters on options. The first one primarily deals with option payoffs, understanding the basic payoffs from options at expiration. And chapter 16 is about option pricing. So in chapter 15, we introduce the call and put options, how they work, some terminology related to these options. What is the exercise price or strike price, what is the option premium, what are in the money options, out of money options, and at the money options. We introduce these terms for both the call and put options, so make sure you're familiar with what this means. We also talked about American and European options, right? So American option can be exercised at any time up until expiration. European option can only be exercised at expiration. Okay, and then the most important thing from the options discussion is familiarity with option payoffs for both the buyer and the writer at expiration, right? So what is the call option and put option payoff at expiration for the buyer and the writer? So for that part, again, make sure you are able to do the payoff calculations. Make sure you are familiar with this payoff diagrams at expiration for both the buyers and the writers of call and put options. Okay, you can actually skip this part here, options versus stock investment. This was just to illustrate how options can be very risky, but they can also be judiciously used as a part of a strategy. But if you understand the payoffs, I guess you already know these things, so you don't need to worry about this section here. Okay, and then you make sure you are familiar with this option strategies. So we talked about three strategies in detail: protective put, covered call, and straddle. We looked at how protective put serve as an insurance, how we can use covered call to generate extra income while meeting our investment goals, and how straddle is sort of a non-directional strategy that can allow us to profit from both significant up movement or down movement in the stock price, right? So make sure you know how these strategies work. And again, an understanding of this strategies hinges on your thorough understanding of the option payoffs. All right. One more time, I want to emphasize, whenever we are doing the payoff calculations for the writer, make sure you think from the buyer's perspective, and the best approach is to view this as buyer's gain is writer's loss and vice versa. Okay, so we covered that in chapter 15. Chapter 16 on option valuation. So here we started out with introducing the intrinsic and time value of the option, right? So intrinsic value is zero if option is out of money. Otherwise, for an in the money option, the intrinsic value is whatever payoff you can get from immediate exercise of the option, right? So this is applicable to both the call and the put option. And then whatever extra you're paying in the premium is the time value, right? So we talked about intrinsic and time value and learned how to compute the intrinsic and time value of options. And then we looked at the six factors which affect the price of the option, right? So we sort of discussed this intuitively, how these six factors determine the option price, what happens to the price of the call option when stock price goes up or when exercise price goes up, and so on, right? So make sure you are aware of the relationship between these six variables and the option price. Like I said during our lecture, you can escape the black shoals. You don't need to worry about black shoals or any related calculations, but you need to know what implied volatility is. Implied volatility is the volatility of the stock that is backed out of black shoals option pricing formula. Okay, and in particular, VIX, which is the implied volatility of S&P 500, is very important. This is commonly viewed as a fear indicator or fear gauge. It is an indicator of how panicked the investors are in the marketplace, right? So that is implied volatility and VIX. And lastly, we talked about put call parity. Again, you don't have to worry about the derivation of this relationship, but just know this relationship, that the prices of four commonly traded assets, the call, the put, the stock, and the bond, they are linked together in a precise relationship. The call plus bond price equals put plus stock price. So basically, this is a no arbitrage relationship. If this relationship does not hold, that implies that one or more of these assets are mispriced, and you can actually take advantage of that arbitrage opportunity. Okay, so if you know the price of three of these assets, you can then compute the price of the fourth one from this put call parity relationship. All right, so that is the idea behind put call parity. All right, so those are some of the highlights from this 5 chapters that we will cover for our midterm next week. Again, if you have any questions, feel free to ask me on Zoom, or feel free to send me an email.